Tomorrow morning, the U.S. Bureau of Labor Statistics will release the Non-Farm Payrolls Report, otherwise known as the jobs number. And this will be the single most important jobs number, well, since the last one. But it's still going to be really important. There's a lot riding on this. And right now, the labor market is behaving kind of wonky. You've got people at the Federal Reserve are talking about tightness in the labor market, and other people are saying there's some cooling in the labor market. Let's look at what's really going on in the jobs market to see what is happening in the U.S. economy, because there's so much riding on this. The stock market, the bond market, housing, it all depends on people's jobs and the unemployment rate. And when you look at the charts and you look inside the data, there are some early warning signs in the job market that the unemployment rate might be about to rise. And guys, fair warning, you just will not get an accurate picture of the labor market if you only look at what they tell you in the financial press. Then you get headlines like this cringeworthy job over at CNBC from 2 days ago. Job market is undergoing an immaculate cooling, says economist, but there are pockets of heat. So, okay, CNBC, glad we cleared that up. An immaculate cooling with pockets of heat makes perfect sense to me. The mainstream press is going to say whatever makes you want to FOMO into NVIDIA stock or Microsoft stock. They're going to say whatever makes a certain politician look good. They're never going to go into the data and say what actually is happening in the labor market. So then let's look at what actually is happening in the labor market. Let's start with 2 days ago when the JOLTS report came out. This is the Job Openings and Labor Turnover Survey that the Bureau of Labor Statistics puts out. And all the way over there, you can see for the month of June, there was 9.56 million job openings in the United States. That's down 34,000 from the previous month. Now you can see here represented in this chart, the job openings in the U.S. has been in decline for the last couple of months. And of course, as they say, when in doubt, zoom out. When you back up on this chart, you can see that the decline in job openings has really been happening since about the beginning of 2022, when there was nearly 12 million job openings in the United States. That's when we got all those headlines about the labor shortage and all the Keynesians were worried about wage spiral inflation. There was just too many job openings in the U.S., or were there really? Because there was a very big change in our job market that happened after the pandemic. And that was the work from home phenomenon. And I got to send a shout out to the Happy Hawaiian on Twitter, who's been posting this chart. He first brought this to my attention back in December when we did an interview. What you're looking at in this chart, first of all, in red, that is the unemployment rate and the corresponding number of job openings, or the vacancy rate that goes along with that unemployment rate. Now, the red numbers is after the pandemic, and the gray and the black numbers is before the pandemic and before the Great Recession. Now, you'll notice in this chart, since the work from home phenomenon started, there are now much more vacancies for the corresponding level of unemployment than there used to be. And the Happy Hawaiian's theory, which I agree with, is that the work from home phenomenon is resulting in the same job being posted in multiple cities across the country. So we have much more vacancies, even though the unemployment rate being where it is right now. Pre-pandemic, we would have much fewer vacancies. Well, pre-pandemic, work from home wasn't really a big deal. Now it is. So that 9.56 million job openings in the United States is not nearly as rosy as you think it is, because a lot of those are duplicate job openings that are posted in multiple cities for the same job. Now, also in that JOLTS report we got a few days ago, we got job quits, the number of people leaving their job in the United States every month. And for the month of June, we had 3.77 million people in the United States quit their job. That's down by 295,000 versus the previous month. So much fewer people are quitting their job every month versus some of the previous months earlier this year and back in 2022. And once again, when in doubt, zoom out, you can see that this decline has been going on for quite a while. The Great Resignation, as it was known in 2021 and 2022, when everybody was leaving their job chasing higher wages elsewhere, well, the Great Resignation is in decline, but it's still going on. You've still got a lot of people leaving their job every month, more so than before the pandemic, but not by as many as before. Now, this morning, we got our weekly initial jobless claims. 227,000 people filed for initial jobless claims. That was up a little bit versus the previous week, but you'll notice that since about early June, the number of people every week filing for unemployment has dropped pretty substantially. Earlier in the year, we were getting all kinds of headlines about tech layoffs over and over again in January, February, March. That resulted in higher unemployment claims or higher initial jobless claims. Well, those headlines have kind of fallen by the wayside. They've slowed down, and now we're seeing initial jobless claims start to fall. So this is saying maybe the jobs picture isn't so bad. And you get the same thing when you look at continuing claims. You get the same trend since about June, really May for this chart. The number of people filing for unemployment, and in this case, remaining on unemployment for several weeks, that number is slowly in decline, a slight uptick last week from 1.67 million to 1.7 million, but still down versus prior weeks. So these last two charts, it kind of looks like the rate of people losing their jobs has slowed. Maybe not so much, though. Let's not forget this story from earlier this week. Yellow Trucking, that's 30,000 people in one shot that lost their job when Yellow went out of business. That's all people who are going to hit those initial jobless claims in the next few weeks, driving that number higher. And let's not forget, Yellow moves things around the country. So if the company that moves the things is going bankrupt, then it's a good bet that the companies that sell the things that Yellow was moving, well, they're probably not doing so well either. And we could have job losses further upstream in the supply chain coming if Yellow is any indicator. And we had even more data came out this morning. We had the productivity and cost report for the second quarter of 2023 came out today. And this report has both good news and bad news for the American worker in here. Non-farm business sector labor productivity increased 3.7% in the second quarter of 23, as output increased by 2.4% and hours worked decreased by 1.3%. So the average American worker was more productive in the second quarter. So when they talk about productivity, they're talking about the dollar value of the goods or services produced per hour worked by each laborer. Now, this is a very deflationary statistic. We're getting more economic output per unit worked. That's a good sign for the health of the American economy. And there's also some good news for the average worker in here as well. Unit labor costs in the non-farm business sector increased by 1.6% in the second quarter, reflecting a 5.5% increase in hourly compensation and a 3.7% increase in productivity. So this is a rare reprieve from inflation for the average American worker. Their compensation went up by 5.5%, even though their productivity went up by 3.7%. So for once in our lives, the average American worker is actually seeing a bigger share of the increase in productivity. And I would add that that 5.5% increase in compensation, that's higher than the current rate of inflation. And so finally, after 2 years of being crushed by inflation that exceeded their wage gains, the average employee in the United States is actually getting a real raise at this point. This is U.S. real average hourly earnings. This is the year-over-year change in people's hourly income adjusted for inflation. Now, you can see right here next to me, this number has been in negative territory for 2 years. That means even though people got nominal raises, your wages went up a little bit, inflation was much higher than your raise, so your cost of living went up faster than your income, meaning you got poorer. That was for 2 years that was happening. Now, finally, in the last month over there, we've actually got an increase in real hourly wages. For once, our income is going up faster than the rate of inflation. Now, that's little comfort to somebody who spent 2 years getting poorer, but at the very least, we're finally trending in the right direction. But there is a flip side to that coin. If people's compensation is rising faster than their productivity, then that means the profit margins of their employers are getting squeezed. And when profit margins get squeezed, that is not a good thing for the people who work for those companies. And you can already start to see trouble brewing. Back to that first sentence in this report, hours worked decreased by 1.3%. Now, when profit margins get squeezed, one of the first things that employers start to do is they start to cut back on their people's hours. They don't cut people right away. They cut hours first. And if things don't improve, then they start cutting people. And you can see here in this report that they've already started cutting hours. And as you can see in this chart of average weekly hours, this has been going on for quite a while. They've been cutting our hours since pretty much January of 2021 when we hit the peak of the labor shortage. Ever since then, the number of hours has been cut slowly but steadily for really the last 2 years. And again, first you cut the hours, but when that doesn't work anymore, then you start cutting people. So as much as I would love to celebrate that finally the average American worker is getting a break and we're actually seeing real wage growth, your wage is finally going up higher than the rate of inflation after 2 years of negative real wages, We're already starting to see that this is squeezing the profit margins of the employers. They're already cutting back the hours. And the next step, when that doesn't work anymore, is you start cutting the people. And that is exactly by design. That is what Jerome Powell and the Federal Reserve are doing on purpose, trying to drive unemployment higher to stop those wage gains. This has been done to us over and over again since 1971. And folks, here it is. WTF happened in 1971.com. And if you've never been to this website, I highly recommend you check this out. I'll put a link down in the description below to WTF happened in 1971. And right here in this beautiful, awful, terrible chart, you can see everything wrong with the United States economy. You'll notice from 1948 all the way up until 1971, as Americans' labor productivity increased, our wages were increasing at the same rate. Everybody was getting more wealthy. Everybody was prospering. Both employee and employer were benefiting equally. It was a pretty good setup. And then in 1971, Nixon took us off the gold standard. And well, look what started on a T right in 1971. Our productivity continued going up. But as they started inflating away the value of our currency, our wages didn't go up as fast. And since 1971, we've seen a 115% increase in our compensation, even though our productivity has gone up by 246%. That means there has been a disproportionate gain for the ownership class, while the working class has gotten poorer due to inflation. This is not a tax problem. This is not a greed problem. The problem is the money. When we went off the gold standard and when 2% inflation became the policy of the Federal Reserve, that's when the water in the pot started boiling at just 2%. And so we, the frogs, did not notice that we were being squeezed by inflation, and we never jumped out of the pot. And now we're left with this massive gap between productivity and compensation, courtesy of the Federal Reserve and our policy of never-ending inflation. Check out WTF happened in 1971.com. There are tons of charts like this, and they all turn on a dime right at 1971. And that brings us to the Non-Farm Payrolls Report that comes out tomorrow. The market is expecting 200,000 jobs created. We only got 209,000 last month, and you'll notice that the jobs created has been in decline thanks to the Federal Reserve's interest rate hikes, trying to stop the wage growth, trying to stop the inflation, inflicting even more pain on the working class who are already suffering from inflation. So the market is expecting 200,000 jobs added tomorrow. Which brings me to the market reaction to the jobs report. Now, what you're looking at here, this is the CME Group's Fed Watch tool. This is where they use interest rate futures to try to handicap the likelihood that the Federal Reserve is going to raise interest rates again at their September or November meeting. Now, right now, you can see right next to me here, we've got an 82.5% likelihood that the Fed does not raise interest rates at the September meeting, and only a 17.5% chance that they do raise in September. And you see something similar with the November odds of a rate hike. Right now, almost a 70% chance of no hike even in November, and the market is only pricing in a 28% likelihood of a hike by November. Now, the reason I mention this is because the market right now is pricing in that the Fed is done raising interest rates. So if we get a low jobs report tomorrow, say we come in at 200,000 or even below 200,000, well, the market is already pricing that in. So we shouldn't see a massive surge in stocks tomorrow if we get a low jobs report, because right now the market is very optimistic that the Fed is done raising rates with only a 28% likelihood of a hike by November. But what if we get a big jobs report tomorrow? It's possible. We've had some really big jobs numbers so far this year. If we come in over 200,000, well, right now the market is not accounting for that possibility, with only a 28% likelihood of a hike by November. So if we get a much higher than expected jobs report tomorrow, the stock market could dump lower because the market will have to readjust pricing in the likelihood of another rate hike by November. So once again, because of the Federal Reserve, we're into that situation where good news is really bad news because of what it might make the Fed do. So long story short, when you look at the labor data right now, there are some reasons to be optimistic. There's still millions of job openings and real wages are finally rising, but there's also reasons to be pessimistic because the job openings kind of tells a misleading story because of changes since the pandemic. We've got that yellow story and a lot of people losing their jobs, and the fact that employers are already starting to cut back on the work week. That's usually a predecessor to job losses. And of course, the Federal Reserve is standing by to make a mess out of everything, where bad news is good news and good news is bad news, because nobody really cares about the health of the economy. It's only about what will the central bank do. Till next time, live small and dream big.